Welcome. During this video, we discuss more financial analysis methods and cover these in more detail. You should also use the student notes for this lesson to see some practical example calculations for each of the formulas we discuss in this lesson. Financial analysis is the assessment of the expected financial viability, stability, and benefit realization of an investment option. It includes a consideration of the total cost of the change as well as the total costs and benefits of using and supporting the solution. Business analysts use financial analysis to make a solution recommendation for an investment in a specific change initiative by comparing one solution or solution approach to others based on analysis of the initial cost and the time frame in which those costs are incurred, expected financial benefits and the time frame in which they will be incurred, ongoing costs of using the solution and supporting the solution, risks associated with the change initiative, and ongoing risks to business value of using that solution. A combination of analysis techniques is typically used because each provides a different perspective. Executives compare the financial analysis results of one investment option with that of other possible investments to make decisions about which change initiatives to support. Financial analysis deals with uncertainty, and as a change initiative progresses through its life cycle, the effects of that uncertainty become better understood. Methods for expressing the cost-benefit comparison. Organizations use a combination of standard financial calculations to understand different perspectives about when and how different investments deliver value. These calculations take into consideration the inherent risks in different investments, the amount of upfront money to be invested compared to when the benefits will be realized, a comparison to other investments the organization could make, and the amount of time it will take to recoup the original investment. Let us now delve into the more detailed metrics, understand their purpose, and the formula associated with each. Return on investment, ROI. The return on investment, ROI, of a planned change is expressed as a percentage measuring the net benefits divided by the cost of the change. One change initiative, solution, or solution approach may be compared to that of others to determine which one provides the greater overall return relative to the amount of the investment. The formula to calculate ROI is return on investment equals, in brackets, total benefits minus cost of the investment, close brackets, divided by cost of the investment. The higher the ROI, the better the investment. When making a comparison between potential investments, the business analyst should use the same time period for both. Discount rate. The discount rate is the assumed interest rate used in present value calculations. In general, this is similar to the interest rate that the organization would expect to earn if it invested its money elsewhere. Many organizations use a standard discount rate, usually determined by its finance officers, to evaluate potential investments such as change initiatives using the same assumptions about expected interest rates. Sometimes a large discount rate is used for time periods that are more than a few years into the future to reflect greater uncertainty and risk. Present value. Different solutions and different solution approaches could realize benefits at different rates and over a different time. To objectively compare the effects of these different rates and time periods, the benefits are calculated in terms of present-day value. The benefit to be realized sometime in the future is reduced by the discount rate to determine its worth today. The formula to calculate present value is present value equals sum of, in brackets, net benefits in the period divided by 1 plus discount rate for that period for all periods in the cost-benefit analysis. Present value is expressed in currency. The higher the present value, the greater the total benefit. Present value does not consider the cost of the original investment. Payback period and payback calculation. The payback period provides a projection on the time period required to generate enough benefits to recover the cost of the change, irrespective of the discount rate. Once the payback period has passed, the initiative would normally show a net financial benefit to the organization, unless operating costs rise. There is no standard formula for calculating the payback period. The time period is usually expressed in years or years and months. The simplest way of contrasting the costs and benefits is by means of what is called a payback calculation, and an example of this is given below. Payback calculations have the great advantage of being simple to prepare and understand. Also, in times where inflation and interest rates are low, they also provide a reasonable picture of the costs and benefits of a project. Discounted cash flows and net present values. The problem with a payback calculation, however, is that it takes no real account of what is termed the time value of money. What this means is that, say, $100 spent today will cost more, taking inflation into account and the rate of return that it could have earned if invested, than the same sum spent in 5 years' time. In investment appraisals, therefore, especially when comparing the relative merits of competing projects, it is desirable to use some method of calculation that takes account not only of how much is paid out and received, but exactly when these inward and outward cash flows occur. A technique that addresses the time value of money is discounted cash flow, or DCF, and this produces a net present value, NPV, for the project. The net present value takes into account the cost of borrowing the money needed to finance a project, or, alternatively, the interest foregone by investing in the project. In other words, it reflects what else could have been done with the money. I recommend you look at your student notes for a good practical example where the DCF and NPV methods are applied and compared. In summary, during this video you have learned more about the most common financial metrics which are used to judge whether an investment is worth doing. Depending on your business case and the types of solutions you are proposing as options, you would need to show some of these metrics to assist in your case for your recommended solution. As mentioned already, have a look at the examples provided in your student notes to see how each of these calculations can be applied in a real-world scenario. I look forward to discussing the next topic with you during the next video.